Okay, now we're going to be looking at the accounting equation. This is very, very important, right? The accounting equation, what is the accounting equation? It's A equals O plus L. That's how we refer to it. A stands for assets, O is your owner's equity, and L is your liabilities. So your assets equal to your owner's equity plus your liabilities. Next question, what are assets? Okay, so here are some examples of assets: equipment, inventory, furniture, cash, buildings, right? So assets are separated into current assets and non-current assets. Current assets are short-term assets. In other words, they change all the time and usually within less than 12 months. So examples of current assets would be bank, right? Hopefully your bank account is increasing and not decreasing, right? But it's changing all the time, right? It'll go up, it'll go down. It's changing all the time. So within that 12-month period, it keeps changing. Inventory, hopefully your inventory is also moving all the time. Wouldn't be good for your inventory to be the same for 1 year. Okay, so your inventory would be changing all the time. So that is a current asset. And then things like petty cash, cash float, those also fall under current assets, right? So something that's changing all the time, right? So less than 12 months. In terms of months, what differentiates long and short term or current and non-current is your 12-month period. Things that you have purchased, which you plan on keeping for a long time and not selling within 12 months. Equipment, so using equipment in your business, it's usually like a long-term investment. Machinery, furniture, land and buildings, these are all non-current, which means they are long-term. You plan on keeping it for a long period of time. The one exception would be if you are in the business of selling motor vehicles, and you are buying vehicles to resell, this would not be a non-current asset. It would be a current asset because in this case, it would form part of your inventory because that's what you are buying and selling, right? So here you can see there's a picture of a donut and a milk. So this is milk. It's probably like, one of the shops that you just go to buy your bread and milk, etc. So that's what they're selling here. So this is their inventory. But if you are selling motor vehicles, then the vehicle would be your inventory, right? But if you are buying, say you're buying 4 motor vehicles, right? And one you're buying as a delivery motor vehicle. In other words, you're buying to keep it for deliveries. So that would be a non-current asset, a long-term asset, because you plan on keeping it for more than 12 months. Whereas the other 3 you're buying for resale, so those would form part of your trading inventory. So it's also important to take note of what the business is. What are they selling, right? Because that can help you to differentiate if something is inventory and a current asset compared to a non-current asset. Okay, so assets, the definition of assets, an asset is a present economic resource, right? So it's a resource, it's something that you can use, something that you have, which represents a right that has the potential to produce economic benefits. So that resource is going to help you to bring in more money because to produce economic benefits. So your inventory, if you sell your inventory, you're getting money. Hopefully you're making a profit. Your equipment, you're using it in your business and it's going to help you to bring money in. If it were a machine, you would be using the machine to maybe manufacture whatever you're selling. And that's going to help you produce economic benefits. Your land and buildings, you probably got offices there, right? Or even if you're renting out, you know, it's going to bring money in because you're going to receive rent income. Okay, so these will result in future economic benefits, and it has to be controlled by the entity as a result of a past event. So if we go back to the example of the motor vehicles, the past event would be when we bought the motor vehicles. And the reason they use the word controlled, they say controlled by the entity, because if you bought it and say you're still owing, say you bought a motor vehicle and you're still owing the bank money on it, right? So you don't actually own it yet because you haven't fully paid for it, but it's controlled by you because you can decide who uses it and who doesn't use it. So you have control of the motor vehicle. So it would still be an asset in your books, even though you have not fully paid for it. Reason is control, you control it. Okay, so that was assets. Right, so A equals O plus L. Now let's discuss owner's equity. Owner's equity is made up of capital. Capital is anything that the owner puts into the business. It's called capital. Anything that the owner takes out of the business is called drawings, right? So the difference between the capital and drawings is the owner's net contributions. And then your accumulated profits. Accumulated profits, the difference between your income and expenses is your profit, right? So your owner's equity is made up of your capital, drawings, and your profit, which is your income and expenses. Then your liabilities. Liabilities are what you owe to people. So if you bought goods on credit and you owe someone money, it's a creditor, right? It's called a creditor. If you borrowed money from the bank and you owe the bank money, that's a non-current. Also with your liabilities, you can differentiate between current and non-current. Creditors would be current liabilities. Loans, that would be a non-current liability because it's long-term. Your loans are usually for like 5, 10 years, 20 years, depending on how much you borrowed, okay? So your loans would be a long-term or a non-current liability. Creditors, unpaid bills, those are all current liabilities. Also with your assets, another important one is your debtors. Debtors or accounts receivable, those are people that owe you money. So previously we used to only call it debtors, then they changed it a bit, they made it a little fancy, and then now they use the word accounts receivable. So that's money due to you. Right? So if people buy goods on credit from you and they owe you money, that's an asset because it's money due to you. And in the same way with liabilities, I told you creditors, also known as accounts payable. That's money that you owe to people. Okay, so the accounting equation. If a company keeps accurate records, the accounting equation will always be in balance. So what does that mean? Remember I said A equals O plus L, assets equals owner's equity plus liabilities. So it means your assets, whatever's on the right side of the equal to sign, has to be equal to what's on the left side of the equal to sign. That's simply what it means, okay? The balance is maintained because every business transaction affects at least two of the company's accounts. So for example, when a business borrows money from the bank, the company's assets will increase and its liabilities will increase by the same amount. So if a company had to borrow 100,000 Rand from a bank, think of what would happen. Your bank account is going to increase because 100,000 Rand is coming into your bank account. So bank is an asset, it's a current asset. So bank increases by 100,000. So it means your assets increase by 100,000. And because you borrowed money from, say, another bank, right? Your liabilities are also going to increase with 100,000. So A increased by 100,000 and L increased by 100,000. So A equals O plus L. And your owner's equity, nothing happened there. So that would be 0. Okay. So since there are two or more accounts affected by every transaction, the accounting system is referred to as a double entry accounting, right? So it will always remain in balance as long as there are always two accounts or more that are affected. Okay, proprietary accounts. So what are proprietary accounts? These are transactions between the owner and his own business. So there's two types of proprietary accounts. The capital account, I mentioned this earlier, when the owner contributes anything to the business. So it could be cash, it could be other assets. So it could be a motor vehicle of his own that he contributed to the business's capital. It could be furniture, it could be equipment, it could be anything, right? Not necessarily cash. This increases the owner's equity, right? So it increases O. Then the drawings account. This is used when the owner withdraws cash or other valuables from the business for private use. This results in a decrease in owner's equity because if the owner is taking something from the business, it's decreasing the worth of your business. So your owner's equity is like your worth. What's your business worth? So it decreases the worth of the business. The owner could take cash, he could take inventory, he could take a machine, he could take anything from the business, right? Not necessarily just cash, right? So if the owner takes anything from the business, we call it drawings, and it decreases the owner's equity. Okay, so your owner's net contributions is your capital minus drawings. So capital, what he put into the business, minus drawings, what he took out of the business. And since assets equals owner's equity plus liabilities, this is our basic accounting equation, we can now say that since owner's equity, we said owner's net contribution is capital minus drawings, we're going to substitute these words, owner's equity, with capital minus drawings. So you'll see further down, it says here, assets equals, instead of saying owner's equity, we're saying capital minus drawings plus liabilities. So we're just expanding the accounting equation to see what exactly is owner's equity made up of. Now, the equation that I've shown you here, it applies in the absence of income and expenses. So we haven't yet included income and expenses. We're going to do that just now. Okay, so what is profit? Profit is the term used when a business makes money. So if a business buys trading stock for 60,000 and sells it for 100,000, it means they made a profit of 40,000 Rand. Okay, so income, what is income? Income refers to the increase in economic benefits resulting from economic activities of a business during an accounting period. It results in an increase in owner's equity. So remember, owner's equity is your worth of your business. So if your income is increasing, the worth of your business is increasing. So examples of income accounts, sales, right? When you sell goods, you receive money, that's sales. The selling price was, this example, we said 100,000. So it means your sales would have increased by 100,000. Rent income, that's an income account as well. If you're leasing out your property to someone, you're receiving rent. Interest income. So if you have a favorable bank balance, you would receive interest income. Or if you've invested money in a long-term or fixed deposit, then you'd receive interest from there. So that is income. Expenses. Expenses refer to the decrease in economic benefits resulting from economic activities of the business during an accounting period. It results in a decrease in owner's equity. So the worth of your business is decreasing because money is leaving the business. So examples of expenses, cost of sales, that's an important one. So earlier on, we had spoken about when we sold goods, we said we bought it for 60,000 and we sold it for 100,000. So it means that our cost of sales was 60,000 because that's what those goods cost us. So if I took my sales minus my cost of sales, my income was 100,000, cost of sales and expense was 60,000, and the difference gives me my profit of 40,000. Okay, and then other examples of expenses, rent expense. So if you have to pay rent for the property you're using, that's rent expense. It decreases the worth of your business because money is going out. Interest expense. So if you borrowed money, if you took a loan from the bank and you need to pay interest on it, that's an expense. If you have an unfavorable bank balance, in other words, instead of having money in your account, you actually gone into overdraft. So you owe the bank money. Okay, so you would pay interest on that. So that's an expense. It's called interest expense. Telephone, advertising, right? And there are many more other expenses. Water, electricity, rates, those are all examples of expenses. Okay, now just to explain a little bit more about cost of sales. So I told you what cost of sales is, and we used the example we did earlier, and we said the 60,000 was our cost of sales. So expenses incurred when trading stock previously purchased is sold. When the business initially purchases the trading stock, assets increase. So when you buy goods initially, right, your assets will increase because trading stock is an asset, right? So depending on how you paid for it, if you paid cash for it, it means that your bank account would decrease and your trading stock would increase. So there'll be an increase and decrease in your assets. Then when the trading stock is sold, the asset is expensed. In other words, only when you sell that trading stock, then you would account for the cost of sales on it, right? It doesn't happen immediately when you buy it. It's only when you sell the trading stock do you account for the cost of sales. This is very important because whenever a business purchases an item, it's either an asset or an expense, and the bookkeeper needs to allocate the purchase to the correct account category. You'll see in the next topic, I'll go into a lot more detail about this cost of sales. Okay, so the accounting equation now, if we have to include income and expenses, right? Remember, income minus expenses is your profit. So this is the expanded accounting equation. A equals O plus L has now become assets. A equals capital minus drawings plus your profit. So this all forms part of your owner's equity plus your liabilities. Right, so I've just expanded that owner's equity into capital minus drawings plus profit. And profit is the difference between your income and expenses. Okay, and you can see that here as well. So here what they've done is we just swap this around. Equity, we normally say owner's equity plus liabilities. Here it says liabilities plus equity, but it's the exact same thing, right? So what I want you to concentrate on here is the bottom part of it. Equity is made up of your capital minus your drawings plus revenue or your income minus your expenses. So revenues here, they're just referring to all of your income. Usually revenue is the same as sales. They normally wouldn't substitute it with the word income, but here they've done that, right?